Welcome to the Land to Lots podcast, powered by Launch Development Finance Advisors. And now your host, Carter Froelich.
Welcome, everybody. This is Carter Froelich, and glad to be before you again in the Land to Lots podcast. Today, I'm excited to welcome my friend and colleague, Chris Bley, to the show. Chris currently serves as the co-president and chief investment officer of IHP Capital. He also is a partner in Newport Pacific Company and previously served as the senior vice president for Lehman Brothers Holdings. For those of you not familiar with IHP Capital Partners is a residential investment firm providing equity for residential development projects throughout the U.S., and their primary focus is in the Western United States. In today's episode, I'm going to be talking with Chris about one of the most critical components of development, that being equity. Chris, welcome to the show.
Thank you. Real pleasure to be here.
And Chris, before we get started, maybe you could share with our listeners a little bit about yourself and then fill in the blanks related to IHP Capital.
Sure. Besides being a Scorpio and liking long walks on the beach and smooth jazz, I've been in the business over 20 years. Grew up in the business. My father happens to be a land use attorney, so I joke that I was the only sixth grader that knew what a tentative track map was.
How about CEQA?
It put food on the table.
Yeah.
And he still can't understand why I chose the business that I did. But just through dinner conversation, I became infatuated, and I use that word specifically, in the business of land development and then finance. One of the things my father taught me, and he taught me a lot, was always follow the money. So you take that combination of learning about land use and development, and then following the money. And the way I did that is I went and got my MBA, 4 or 5 years after college, learned about finance, and have been in the business ever since. I didn't know the business that I work in even existed, and that's real estate private equity. One of the reasons why I went to grad school was because I knew there was a lot of things I didn't know. I needed to reinvent myself. And by happenstance, I was introduced to some people and ended up in this business. I've been doing it since 2001, both on the capital side and on the developer side. So I've truly walked a mile in pretty much everyone's shoes. I love what I do. I joke that I could win the lottery tomorrow and I would be at work the next day. I just probably have a little nicer car. I'm in the business of helping to provide housing. That's a noble profession.
Yeah.
I love that every day brings new things. Unfortunately, more often than not, recently it's complications. But I don't know what the next phone call is. It always keeps us on my toes, and I love what I do. I've been lucky enough to be handed over the reins of a company with my partner Richard Whiteley of IHP Capital Partners, which I always considered the gold standard when I worked for a competing firm in the early aughts. And now we, as you mentioned, our main focus in life is providing joint venture equity to builders and developers of residential projects.
Yep. Thanks for that. And when you take a look at your website, you're pretty much all in the Smile States. Is there any particular part of the United States that you're more focused on right now, or is it a deal by deal evaluation?
For the most part, we find markets that we like and then we stick. We are expanding the firm right now. IHP was on the East Coast. They pulled back and we're now looking at some stuff. One of our business plans right now is, and I say this a little, unfortunately, being a fourth generation Californian, but we're following the markets where U-Haul goes.
Yeah.
There is an exodus out of California.
Absolutely. Mm-hmm.
Without getting into any political leanings, there's just a lot of it. That combined with the work from home, I don't think that's a sea change. I think it's just on the margins, but the margins are enough to make a business. We're doing a lot in Texas. We're doing stuff in the mountain states. We like where there are knowledge workers So we've got a bunch of stuff in Salt Lake City. We're doing a lot in Phoenix. We don't think Phoenix is your grandfather's market anymore, but it is the Smile States. But we are right now finishing off the Smile, going to if you're looking at the US, right part of the country.
Yeah, well, there's a huge exodus from California, that's for sure, and for a lot of good reasons, I think. As well.
Yeah,
it's just hard to do business in this state.
That's a topic of a whole other podcast.
Yeah, I know.
Although,
I mean that.
Although I will tell you one funny thing I saw. I was in an office and let me give a disclaimer that I'm not agreeing nor disagreeing. I'm just being an observer here.
Yeah.
That I was in an office in Phoenix and they had the top 10 generators of jobs in Phoenix, and number one was Gavin Newsom. So.
Absolutely, absolutely. And obviously we're working in all those same states, and it is just amazing what's going on in Nevada, Arizona, and in particular Texas. I mean, it's just off the charts. So
yeah, we've also we focused on, or we do focus on, providing joint venture equity. We also will go out and buy master plans. And in fact, one of the most successful deals we've ever done as a company was we bought the Sunfield master plan out in Buda, which is adjacent to Austin.
That was a well-placed bet. Yeah, on that one.
Better to be lucky than good.
Yeah. Well, and let's talk about that right now. So is there a sweet spot of a deal that IHP is looking for? If you could craft these are the type of deals we would always like to do. And, you mentioned the Sunfield master plan in Buda, but could you elaborate on that as it relates to potential sweet spots for IHP?
Yeah, I have two answers on that. Actually three, now that I think about it. Number one, the one company, and it's really not a separate company, it's just a division of IHP, is we do have a build for rent division. That's a brand name of Terralane, and we're big believers in build for rent, but truly building. We will take that entitlement risk. But that leads me to the other two things that we're very high on right now. Number one is land. I am a personal believer that the thing that keeps me up at night right now is the lack of lots on a go-forward basis. The builders have been pretty good about being land light. When you have land it's really trapped equity on a balance sheet, so it doesn't help a builder except for an analyst saying, how can you grow, which is your basic equation that you use for stock valuations. But unfortunately, people aren't getting paid to entitle and develop land right now. The risks are just getting greater and greater. You mentioned CEQA at the very beginning. You have that in California, and we've kind of seen the Californization, if you will, of entitlement processes throughout the United States. Can't tell you how many times I've walked into meetings and people say, hey, you seem like a really nice guy, but you're from California, you leave your politics back there.
Yeah.
So we like land. We think that there's going to be continued value in land. And we also like land because it gives us optionality. We can do our joint ventures with builders, which is our bread and butter. We can sell lots to builders. We can build for rent. We have options. Doesn't mean it's easy. There's not a lot of good capital for it. Unfortunately, master plans, long-term land play don't work very well with private equity just because of the time frame. They're judged on IRR, which is the world we live in, but it's not a good barometer. It really should be much more multiple based. Some of the stuff we're looking at and we really like are what we call midlife master plans. Buda was that, Sunfield was an example of that. Vistancia, which is a master plan we own in Peoria, Arizona, just outside of Phoenix, was another one. These are master plans that are they were both about 10,000 lots, give or take, of which 6,000 to 7,000 lots were already spoken of. Communities were already there. So we knew there was a there, and we didn't have the big heavy lift up front. So we like those a lot. The other thing that we like, going back to our DNA, and as I said, bread and butter, middle of the fairway, use whatever term you want, is we spent a lot of time looking at our portfolio from a forensic standpoint and saying what works and what doesn't. And what we found is we like deals with a story to it. And the ones where we have made mistakes in the past has been when we've done what I'll term commodity housing, or we get enamored with a deal on Excel and we forget the other things that go into it, like the people. do you have the right partner? Having the right partner is everything. And I can speak to that on some of my Lehman experiences. We really like a deal with a story. Because commodity housing, and what I mean by that, and that's not to demean commodity housing at all, it's the majority of new housing, but we're probably going to stay away, which means, of course, we'll do the deal tomorrow, where, we can buy 150 lots with a partner, but on one side is Pulte and the other side is KB. They just work differently and they don't have a choice. They're public builders, and
Yep.
and they will, and I don't say this in a negative, but they'll cut our knees out from under us because they need to make quarterly returns.
Yeah.
So it's great when everything's frothy, but we're selling homes and we like to get paid for doing something a little different. So we're fairly agnostic to the type of home, and that, is it a first-time buyer? Is it a luxury home? We just want a really good reason for it.
Yeah. Boy, I mean, you have so many different things I want to ask you about on just your comment there, but I would be remiss first if I did not ask you, for our listeners, what is the typical deal structure that IHP likes to roll out? And I know everything is deal by deal. Let me just caveat it by first saying that. But is there kind of a structure that you might be able to throw out there?
Yeah, because it's look, we first of all, you're right. No two deals are the same, and we very much want to look at each deal, and it needs to stand on its own merits. We're 90-10 with waterfalls, with a preferred return.
Okay.
I'm going to be that ambiguous about it,
Yeah.
but we're not different than anybody else,
Right.
when it comes to that. Our money is as green as anybody else's. In fact, that's something that we talk about a lot. Money's a fungible, it's a commodity.
Yep.
We are not going to win deals because we're cheaper. You're not going to want to work with us because we're less expensive. I've heard the term a wallet with legs. That's not what we want to do.
Yeah.
We believe very strongly that we add value versus just being a passive investor.
Right.
The guys that founded the company, Doug Neff and Don Grant, first of all, they walk about 3 feet high off the ground in my books. I think they're two of the smartest guys. We're trying to follow in their footsteps. And from that, we take all of our combined knowledge, and that's how we structure deals. That's how we look at deals. And hopefully that's what we offer to our builder partners, that number one, we truly view ourselves as partners. This isn't, here's your check, come back to me when you're repaying me. It's, how can we do this together? Now, we're supporting our partners in their business. We don't want to be in their shorts.
Yeah.
And we aren't in it for the money, but we really want to be good partners. And I think one of the things that separates us is, as I mentioned, I've been on the other side. My immediate partner, Richard, was CFO of a home building operation. So we understand this is not an easy business. And we want to make sure that we're partnered with people that are comfortable with us enough, and it's our job to make them comfortable, that they let us know when bad things are happening just as much as good things, because we see so much.
Right. And you had brought up earlier about partners and how important that is, and that chemistry and the relationship that you have with your partners. What are you really looking for in a partner as you're ready to consummate a deal or considering consummating a deal?
The first thing is as simple and it's kind of corny as it sounds, we have a no asshole policy. Okay. We want to work with people we like.
Yeah.
Now, sometimes we like them up front, and because it's amazing how nice people are to you when they're trying to get your money. But we want people that we like, that we're not, there's nothing worse than having a partner that you dread picking up the phone to either call them or answer. So let's start with that. That's not something they teach you in grad school or any sort of, real estate course, but it's really important. It's really important. Yeah. This is a tough business, and you want people in the trenches with you that you don't mind being in a foxhole with. But then we really want experience. We want people that have been there, done that. We want people of high character, and that goes to back to who they are as a person. We do want skin in the game. Now that's something I can talk about and I have my feelings on, but we do want a co-investment. We want people that understand that we're all going for the same thing, and that is the money. And that sounds a little strange, but there are people that do this for a legacy. That's not a good partner for us.
Yeah.
We can structure around it, but we want to make sure that we're all rowing from the same oars, as the saying goes.
Well, money is a scorecard. That's the
Money's a score.
easiest way to
It's what we
determine
do
if you're
for
heading in the right direction. Yeah.
yeah, and it's what we do for a living, and we consider our fiduciary to our investment partners sacrosanct.
Yeah.
And that's what they hire us for.
Sure.
So it is money. The other thing is, we don't want people that are going out over their skis. We've been burned on that before.
Right. Well, and to that point, Chris, I mean, let's face it, a lot of the land developers are slowly disappearing. They're either through consolidation. There just aren't too many of them around anymore.
There's
So
a
how do you
saying.
look at
There's a
the-
saying that land developers become consultants and then they're gone.
Yeah. What do you think about the new up and comers? Those that are, have been in the business for a while. They're going out on their own. They have experience through another entity. You feel they have good chemistry there. They've got a well-located project. They're getting going. How do you look at something like that for the next generation, if you will?
I have two responses to that: the personal and the professional.
Mhm.
The personal is everybody needs a break at some point.
Yep.
And I would love to give those breaks. Professionally, more often than not, I can't risk that.
Yep.
One of the things that you have to have is on development and vertical construction, you're normally going to have debt. Now, we do provide a product where there are times we can provide the entirety of the capital stack, which makes us very good looking.
Yeah.
But our partners get paid promotes for a reason, and one of those reasons is they're bringing in the debt, and they're normally putting themselves on the line there.
Okay.
Even if it's technically non-recourse, at least in completion guarantees, etc. So you can't. So I would love to give people shots, as a break. The problem is they need a staff. They need some financial stability because they got to keep their staff.
Yep.
We don't want them going, buying a BMW and having the license plate of first draw, which I've seen.
I've seen that.
I'd rather they already own the BMW. That being said, it's a bit of a conundrum.
Yeah.
Because how do you get a new guy in business, and how do they replace the old guard?
Yeah.
But I just don't have that luxury as a fiduciary to really go out on a whim and vouch for someone like that.
And to dovetail into the next question, when you're out raising institutional capital, first of all, what are you telling your institutions that you're courting? And number two, what is it easier, harder, the same? How has that raising capital changed in this new interest rate environment we're in?
Raising capital sucks.
Yeah.
There's no better way to say it. I've been predominantly residential my entire career, and we've always been kind of the redheaded stepchild. We are not, and there's a bunch of reasons, and anybody that knows me has probably heard this out of my mouth and they're sick of it, but it's a statistic that always blows me away. The aggregate value of single family homes in the United States is something like 35 to 40 trillion, depending on what day it is, which far outweighs any other asset class in real estate. Yet there are so few institutional groups that are focused or even dabble in residential, which on the surface doesn't make sense, but when you dig down, it makes a ton of sense. The check sizes aren't as big. You have taxation issues. It's harder to value. It's not like buying an office building and saying, well, the average lease is 5 years. Therefore, the average, 20% of our rent roll rolls every year. And we got TIs, and we're in a standard deviation of cap rates. There's, umpteen thousand inputs that go into residential. So it's tough raising money from institutional capital. They also still, from 2008, think of land as a 4-letter word. Yet most of the people we deal with own their own homes.
Yeah.
And they've made, and real estate,
Yeah.
I believe, is the biggest wealth generator in the country. So there's a bit of a duality there that's hard to get over, but it's really hard because, the other thing is there's a guy I met who I hold in very high esteem, named Joe Aisleby. And when I met Joe, he was head of hard assets at JP Morgan. He now does it at UBS.
Mhm.
And he taught me how money works and how so much of the money that's in the system for investment comes from pension funds. And all these pension funds are advised by about 3 to 5 groups.
Yeah.
And, this is where our PR person cringes, but I'll say things like, and they're all lemmings. And so they don't want to go out on a limb and say, hey, we really think this is good, because it is so kind of outside of the box. But the long and short is raising money sucks.
Well, yeah, and to that point, I mean, given all the different asset classes and the challenges that they're experiencing right now, land would look pretty good. I mean, we have a shortage of lots. I mean, as long as you're buying in the demand areas, you follow the U-Hauls, you should probably do pretty good if you have the bandwidth to stay the course for a large land development project.
I would say if you have the bandwidth and the intestinal fortitude, and you're in bed with someone that knows what they're doing.
Yep.
I mentioned this earlier, that master plans, long-term land deals don't work well for private equity just because it's not the invest in 3, harvest in 4 type of thing. But for pension funds, for family offices, for endowments, I think there should be more investment in land. Just so few people know it, and you can't just dip your toe. If you dip your toe, my sympathy is limited.
Yeah.
You got to know what you're doing. But I think residential real estate, from the raw material of land up through the housing, is a phenomenal investment. You look at the history of IHP, we're getting pretty good opportunistic returns throughout since our inception. And we're certainly going to keep working on that and intend to do nothing but better it. But I'm also not Pollyannish to think that, Richard's and my dastardly good looks are going to get us a bunch of money. And I understand how this works. I understand how the portfolio managers work. I understand how the boards and the investment committees work. And it's an uphill battle. But I do think those with courage in their convictions, and as I said, intestinal fortitude, there should be more investment in residential real estate. And part of that trickle down, if you will, is part of the reason why I think houses are so expensive.
Yep.
And there's a multitude of reasons, but one of them is the capital that is used for them. And this is something that the average Joe just does not understand, just because it's not well known, is the money that you see for residential real estate is some of the most expensive money. And what I mean by that is risk versus return, and the return that it's needed out there for investment.
Yep.
And
the problem of using short-term money on long-term projects. And to that point, you mentioned Vistancia, you mentioned Sunfield, both of which had districts, a CFD and a MUD. So,
do they?
Yeah.
Really? Hold on. Is there public finance involved, Carter?
Yes, public finance is involved in those. So I got to get a little plug in here. And so how do you take a look at projects that have or do not have public financing element to them? And in the states, Texas, California, Arizona, Nevada, et cetera, where they have the ability to do a district, is that an important component of the capital stack? Or here again, is it deal by deal, depending on size, et cetera?
Absolutely depends on the deal. And more importantly, I would say the location. If
Yep.
you're doing any sort of development in California, more often than not, a very significant portion of your return is going to be through a Mello-Roos or CFD.
Yep.
And part of that is it's just so damn expensive, and it's so risky to do entitlement and development deals in California. In Texas, if you're making a bunch of money off of the MUDs.
Yep.
Arizona, to a lesser extent, Nevada, you're starting to see it. They're an important component and they're becoming more important. But again, it's on a deal by deal. It's a little scary to underwrite when you say, wow, 100% of my profits come from public finance, because, if I was underwriting a deal 2 years ago, what was the CFD being issued that then?
Yeah.
4.5.
Yeah.
What is it now? 6.5?
Yep.
Okay. You're losing some dollars there.
Yeah.
And so, and yes, they will be there. Like everything else in our business, you can't nail down the timing. And I much more prefer things that we have a direct effect on.
Yeah, exactly.
But they are enormously important.
Chris, we're getting near our time here. And one of the things I like to ask is, over your career, what's been the most surprising learning experience you've had, either good or bad, that you would like to share with the listeners?
There's two things. There's one that it doesn't matter what business it is, and that is, I remember when I was a kid, my father was a young attorney. He changed professions kind of midstream, but I was in second, third, fourth grade, and he was a first, second, third year attorney. And he'd come home and have dinner with us, but then he'd continue to work like most young attorneys do. And he would have all these papers spread out in front of him, and he'd be, this was back in the days of the dictaphone. Anybody born after about 1980, you can go look up what a dictaphone is. It's right up there with the rotary phone. I would sit there and I'd look at him and I'd look at what he's doing, and I thought that as soon as you got into the professional world, everything was correct and factual, and no one made mistakes. And then I worked at Lehman Brothers.
Mm-hmm.
and
we're going to drill down on that one.
Yeah. So I literally worked on Wall Street, and I saw that, no, it's not that way. People make mistakes all the time. People give incorrect information. People receive incorrect information. And that always stuck with me. The biggest lessons I learned were probably when I was at Lehman doing the workouts, learning what works and what doesn't. And, you can do originations all you want. And Lord knows I love originations, but until you do some asset management and workout, that's when you truly learn the business.
Yep. Being in the details, working with what's down on paper and reality on the ground, right?
Reality on the ground, being able to separate, be able to make hard decisions, being able to have very tough conversations.
Yeah.
There are business practices that I've seen. They may be absolutely correct from a business perspective, but I don't know if they were absolutely correct ethically or morally. Not all of them sat well with me.
Right.
You also learn a lot about people when you're doing workouts. But
no, that was a good training ground. Yeah.
Huh?
Lehman was when you were doing the workouts was a great learning experience, I'm sure.
And it was very interesting being at Lehman at the time. Really interesting going to cocktail parties and someone say, "Where do you work?" And Lehman Brothers, and my God, you have to hide the horns.
Yeah.
But I will say this: a huge amount of people I worked with at Lehman were phenomenal people. A lot of them got a bad rap. I still think that whole time in history was mistold. I don't think people understood what people's jobs actually were. And some of the people and there's a lot of guys that and women I still talk to from my Lehman days. And again, I was only there during the bankruptcy. I worked with them. I was at a company that worked with them before, and then certainly was there during the bankruptcy. But I will also tell you, there were a lot of people there that to me were very, very bright people. And to that extent, one of the first comments is, "Hey, I don't know." And when people say, "I don't know," especially when they're in positions of power, I've got a lot of respect for that.
Yep. I agree. Well, Chris, is there anything else that I should have asked you that I didn't, that you would like our listeners to hear about?
Well, besides who I would recommend for public finance?
Well, who would that be?
No, listen, here's the one thing I would say. I'll leave you on this note, and I've said this many times on many panels. I love what I do. I think I I truly do. I love the business I'm in. I think the one negative I would say about our business is we do terrible work at PR. I joke that the developers have taken the place of the Russians as the bad guys in the movies. Although, the Russians are coming back.
Yeah, they used to build statues for the developer of the town. Not
Well,
so
because
much
the developer
anymore.
did it.
Yeah.
But you think how often the bad guy in the movie is the developer. And there's a huge misperception of the development process. And it's kind of our own damn fault because we don't spend enough money as an industry explaining to people the hoops we really have to jump through. I had someone who said, how can you do this? Where is your son going to play when he gets older? And I'm like, well, how the hell did you get a house? It's not a bunch of rich guys going into a back room, smoking cigars, drinking martinis, and trading checks.
Yeah.
There is, and most developers don't view it that way. There's good and bad like any other profession, but there's a lot of environmental work that we believe as an industry is important and then is forced on us. Sometimes I think it's the wrong execution of the right idea, but it is so unbelievably difficult to garner entitlements. It is so expensive to development, and the risk is greater than most people understand. And you add all those things together, and what you get is an industry that is misunderstood, but provides one of the three necessities: fire, shelter, and food. And it contributes to why housing is so expensive.
Yeah.
And it's too bad that people don't understand our business, the finance of our business. The elected officials don't understand. The reaction to housing being so expensive is to tax the developers more. And that's just not how it works.
Yep.
So that's kind of what I would leave it with. But man, I love what I do.
Well, Chris, thanks a lot. And, I between you and Richard and Doug and Don and IHP, you guys have been out there for 30 years, helping the development community, residential home community, put lots on the ground. You guys do a great job. And I really encourage anybody that may have a project that is looking for equity to reach out to Chris and to Richard. I will be putting Chris's contact information as part of our show notes, along with a link to the IHP Capital Partners website. So should you want to have a conversation with Chris, really encourage you to reach out. And Chris, is that okay that our audience reaches out with potential transactions?
As long as they're accepting of the brutal honesty, absolutely.
Bring it on, right?
Don't ask me a question unless you actually want the answer.
No, that's fair enough. Fair enough.
But hey, Chris, if I don't talk to people, we don't do deals, and we don't do deals, I don't have a job. And no, absolutely. And I can't thank you enough for having me on and all that you do for us. And I truly relish our professional and personal relationship, and flattered that you would have me on.
Well, thank you very much, Chris. That means a lot. Appreciate your time.
Thanks a lot.
Well, everyone, that concludes today's episode of Land to Lots. I hope you enjoyed it. And if you find this podcast interesting and helpful, please pass it on to your friends and colleagues, and consider subscribing so you never miss another episode. Thank you very much for your time.
You have been listening to the Land to Lots podcast with Carter Froelich. Follow us wherever you find your podcast to never miss a new episode.